5 strategies for consolidating your credit card debt. High interest rates can bury you under a mountain of debt, so use these tips to dig yourself out. Welcome to 4dinbox.com, where we help you to master your money. So let's get right into reacting to this article. So credit card debt remains a slow motion disaster for millions of Americans. And the funny thing is, it's not actually just millions of Americans, it's literally billions of people in the world, right? Like, people face debt issues all over the world. So despite a sudden dip in balances last year, which can be attributed to fewer spending opportunities during the pandemic, credit card debt is a notoriously widespread issue in the US, and given the industry's sky-high interest rates, once you fall behind on payments, it can be difficult to catch up. If you feel like your efforts to pay down your credit card debt aren't working, debt consolidation can combine all of your credit card balances into one monthly payment, ideally with a lower interest rate. There are a number of consolidation strategies worth exploring, and we'll run you through each to help you identify which is best for you. So the balance transfer card. These are best for those with high credit scores who can repay their debt within 2 years. Again, I've mentioned this before, but I agree, but the caveat is it has to be within this time frame, right? Because if you end up going past this time frame, meaning you end up going past the limit of like no interest, and you have this massive balance, you are going to be paying an arm and a leg, and it's going to be absolutely disgusting. So a balance transfer credit card consolidates your existing credit card debt onto one card with one main benefit: a low introductory interest rate. Most will offer a 0% introductory APR on balance transfers for between 12 to 24 months, allowing you a longer timeline to pay down your debt without worrying about interest. Balance transfer cards often charge a fee for each balance transferred, typically between 3 to 5%, which can really add up when transferring large balances. But again, this works out if you end up basically being able to pay off all of your debt within that time frame, and in some cases, you might actually be offered this without any actual fees, right? Now, this is rare, but it's really typically for those who have extremely high credit scores. We're talking like near 800, 850 level. Like, you got to be way up there to really get something like that, but it is possible. So the pros: you can lock in 0% or low introductory APR for a year or more. Some cards offer long introductory periods for up to 24 months. The cons: most cards with low or no intro APR charge balance transfer fees between 3 to 5% and can lead to more debt at a higher APR if the balance is not paid off during the promotional period. And again, that's the thing. Only do this if you know a 100% for fact that you can end up paying off your debt. Typically, it requires great or excellent credit to qualify for the 0% APR. I agree. So the debt consolidation loan, best for anyone with high debt balances. A debt consolidation loan is an unsecured personal loan that offers a fixed interest rate lower than most credit card APRs and repayment terms spread out over several years. This type of loan may be a better option for those who can't qualify for a balance transfer credit card with a 0% introductory APR. You can even pre-qualify for a debt consolidation loan without affecting your credit score, so you can decide if this debt consolidation method is right for you. Credit unions, banks, and online lenders usually offer debt consolidation loans, and credit union debt consolidation loans typically have better interest rates and more flexible loan terms than other lenders. So shopping around for debt consolidation loans can help you find the right terms for your personal debt situation. Now, for the whole debt consolidation loan, personally, I think it would be best to only use this if, say, you have a student loan balance that is massive with an extremely bad interest rate. Like we're talking like really bad interest rate. And if it's a really bad interest rate and you could get far lower, potentially zero, with a debt consolidation loan, I would go that route easily because you could end up saving thousands upon thousands of dollars by doing that. So the pros: fixed repayment schedule, longer period to pay off the debt, may be able to pre-qualify without affecting the credit score, and lower interest rate than most credit cards. And again, this would really only be best used for something like a student loan balance, because also student loans typically cannot be bankruptable, meaning you're basically 100% screwed if you can't pay it off. You can also secure a debt consolidation loan with less than perfect credit. The cons: must meet individual lender requirements to qualify. Some debt consolidation loans charge an origination fee, and interest rates are based on your credit score. But again, these might be a little bit easier for you to actually end up like smoozing your way, like with like a credit union, which is a lot better than a mainstream bank. Go to like a credit union and talk to them and say like, hey, like, can you guys do a debt consolidation loan onto my student loan debt, right? Like, can I do like a balance over so that I could make payments to you guys at a lower interest rate than to the government or to the student loan company? So the home equity loan, home equity line of credit, or HELOC or refinance. These are best for homeowners with fair to average credit. The thing is, they're suggesting that this is actually an option. I say that this is actually not a viable option in any scenario. But let's go over what they talk about. So homeowners can use a home equity loan and home equity line of credit or refinance to consolidate their debt. A home equity loan is a second mortgage taken against the equity you've accrued in your home that provides a lump sum of cash with a fixed interest rate. A home equity line of credit or HELOC is also based on your home's equity, but works more like a credit card, offering you a revolving credit line you can access when needed. You'll only pay back the amount you take out plus interest with a HELOC, and if you have enough equity in your home, you can use a cash-out refinance to roll your credit card debt into a significantly lower interest rate. So a home equity loan or HELOC can help with debt consolidation, but the risks are higher. If you default on either, you could lose your home to the lender, okay? Pay attention to this. You could lose your home to the lender. That said, this can be a good option for homeowners with equity in their home that have the discipline to pay off the loan responsibly without missing a payment. The only problem is you wouldn't be having to do something like this if you already had the discipline to pay off your loan. Think about that for a second if you end up stumbling upon this episode. This basically shows you that if you are in a position where you're thinking about using a HELOC, it means that you do not have the consistent habits of paying off your debt. Okay? So, no, don't go do this. Don't be a dum-dum. The pros: typically lower interest rates than a personal loan, may qualify for better terms even without good credit, lower monthly payments extended over a longer repayment period. Cons: must have equity in your home to qualify, may require additional fees like an appraisal or closing fees, could lose your home if you default on the loan or line of credits. Next is the credit counseling debt consolidation programs. Best for anyone who doesn't qualify for most debt consolidation options. So credit counseling services can help you understand your finances and how you got into credit card debt in the first place. They also help you create a plan to pay off your debts, which may include a debt consolidation program. There are various nonprofit credit counseling services which offer their services for free or a small fee. Credit counselors can help you negotiate lower interest rates and fees. With a debt consolidation program, you pay one fixed monthly fee that's divided and sent to your creditors. A debt consolidation program does not affect your credit score and may be ideal for someone who can't qualify for other consolidation methods. There are many credit counseling scams online, so be sure to thoroughly vet a company before paying any money. And the FTC has a good checklist to follow when interviewing credit counseling services. Okay, the thing is, technically speaking, this is a good option. However, the sad fact is a lot of these debt consolidation programs, right, are usually done in a way where they're basically going to make you default on all of your loans, okay, on all of your debt. Meaning, if you got credit card debt, they're going to make you default on that. Do you got student loan debt? They're going to make you default on that. Oh, do you got a mortgage? They're going to make you default on that, right? Like they're going to continuously make you basically make super late payments so that they can try to negotiate with the loan sharks basically for a lower fee, right? While taking a cut of potentially what they might save you, which they don't really save you any money, right? You could do everything that they do without you screwing your credit score or screwing your debt situation even more than it already is, right? Because you don't want to get your paycheck basically taken from you, right? Like you don't want anyone to be like have access to your accounts for any reason at all, period, right? So just keep that in mind. You gotta be really careful with things like this, right? That being said, if you need help with mastering your money, learning how to actually master your money, get out of debt, build an emergency fund, and learn how to simply invest that anyone can actually do, go check out 40inbox.com to learn the secret to mastering your money so that you don't have to rely on people that are potentially going to just completely screw you over. Pros. Won't negatively impact your credit score, which again, I commented on this, and this is basically a lie, right? Can reduce interest rates and fees. It can definitely decrease the fees. Fixed monthly payments, technically true, but at the same time, you can still end up getting screwed by this. Available to those with less than favorable credit. That is true. Cons. May require service and monthly fees unless working with a nonprofit organization. Could take years to pay off debt. And credit usage may be frozen while in debt management. So there's not really any benefit to really actually doing it. So a 401k loan, best as a last resort. And we're talking like last resort. Almost at the like equivalent of, saving your life kind of situation. So if you have an employer-sponsored retirement plan like a 401k, you may be able to take a loan against as much as 50% of your balance to pay down existing debt. There's no credit check involved, and interest rates can be lower than other debt consolidation methods. A 401k loan usually has a 5-year repayment schedule, but the total loan amount plus interest will become due if you lose or quit your job. While taxes are not owed on a 401k loan that's repaid, if you can't repay the loan, it can then be considered taxable income and you'll be required to pay taxes and early withdrawal penalty fees. So the pros: lower interest rates, no effect on credit score, 5-year fixed repayment schedule. The cons: may reduce your retirement income. Not may, it will reduce your retirement income. Subject to taxes and penalties if you can't repay. Becomes due in full if separated from the employer in any way. Has caps on the amount you can actually borrow. So this is, again, an extremely horrible option. Like, this is a horrible option. Don't think that this is a viable option in any scenario, but basically, if you're kind of like thinking, oh, I need to do this, or I'll be like 6 feet under, then that is basically an option, right? Like, this is how bad of an option it actually is. Like, it's basically at the point of like, okay, are you going to lose your house? Or are you going to potentially like pass away, right? Like, that's kind of the scenario that you would actually do something like this in, right? So just keep that in mind. Like, you could get really screwed over by taking a loan out on your 401k. So that's pretty much it. Feel free to stay tuned for more reactions to personal finance and all that kind of stuff. And if you need help with mastering your money, if you really are wanting to get out of debt, go check out 40inbox.com and learn the secret to mastering your money. Or go into the description of this episode. Either way, go check out 40inbox.com right now and go learn the secret to mastering your money so that you can live a life of being debt-free.